Hi, Roby.
Hey, Bob.
Hey, how we doing there?
Pretty good. How are you?
Okay. Got
How'd
some.
your team do yesterday?
Well, the Giants actually won. The Giants show a little bit of hope as long as they play Washington, they can win. They beat Washington twice. But the comedy is on tonight. New England is not very good now, and they play the Jets, so this might be the Jets' chance to win a ball game. You know.
So what's with New England? They lost Brady. Was he their whole team?
Yeah, they lost Brady. They've had a lot of injuries. The
Oh,
quarterback they brought in, Cam Newton, didn't work out apparently the way they had hoped. So
I thought he was a sort of a superstar, wasn't he?
yeah, he was the most valuable player in the league. But he's a running quarterback. He's been hit a lot. So, all right, I guess we're going to look at chapter 15 today, right?
Right.
Okay, so just give me a moment here. I've had all morning to prepare, and I didn't rack this one up yet. So just take a second. But I do know that. 110, chapter 15. I want to roll through this real quick. I just want to see something. Okay. All right. Hope you got all that. I just want to pull up one other thing. And one more. Okay, I guess we're ready here. Hold on. Click on this. We go to share this screen. And chapter. It.
Yes. See it now. Yep.
All right, chapter 15. We'll probably go back into 14 for something I'd like to review here. Anything happened in the news last week that you know of?
Oh, nothing much.
Oh, please, please get this guy out of the room. Okay, here we go. Don't want to get into that.
That's okay. I'm deep into it.
Yeah. I'm, on the liberal side, to say the least. And I'm so embarrassed by my classmates from high school. They've turned into almost like the.
Yeah. I mean, I just.
You're on my side, right?
Right.
I'll probably have to trim this out of the video, violating some standards here. Okay, here we go. All right, let's see what we got here. Chapter 15, again, this is going to be repetitive. A lot of this is going back to earlier in the chapter. I also contacted Natalie and Riley. So where have you guys been? It's just me and Roby. So anyway, single step, multi-step income statement. Multi-step means you have some subtotals of the expenses, maybe selling it. Oh, there's Natalie. Hey, were your ears burning just now, Natalie?
Sorry, what?
Were your ears just burning?
No.
Because we were just talking about you.
Oh.
Okay. Is Millie there?
Yeah, she's here.
We'll get this over with quickly, Roby, okay?
Okay.
Roby likes Millie. Okay. You ready to go, Natalie, here?
Ready.
Okay, this is going to be kind of a repeat. We're in chapter 15, and this is where we were when you walked in. I was just saying, where's Natalie when you came here? Okay, the income statement. Well, we know it's revenues and expenses, and they're talking about a single step. That's just where you see sales, and then everything listed below it, basically. Cost of sales goes with the rest of the expenses. Single step. This is kind of what you've been seeing. Revenues, it goes from revenues, gross sales to net sales. We don't have any gross sales here. Net sales, total revenues minus expenses. And notice cost of goods sold is there as a single expense. And it is. Cost of goods sold, of course, is what we paid for the item that we sold. We sold something for $100. We bought it for $30. That's the cost of goods sold. So what we're going to do here is we're going to move that cost of goods sold up and put it into a slightly different category, okay? And we're going to come up with something called gross profit or gross margin. And it's from that we're going to subtract the operating expenses. So in other words, we're going to see sales minus cost of goods sold to give us gross profit. And one of the many reasons you want to do that is cost of goods sold is a unique expense. It's what we paid for our merchandise. You kind of want it to stand on its own so that when you subtract it from the sales, you know what your profit is at that point. And then we can look at the operating expenses. Operating expenses are just what they sound like, whatever expenses are normal in running the business. You know, you have rent expense, salaries expense, insurance expense, a whole ton of things. And then we're going to break them out between selling and general and administrative. Selling expenses, anything associated with your sales department, the salaries of the salespeople, the sales commissions, advertising. They might have a credit card that they use to take potential clients out to dinner, you know. The cost of freight in, when they say delivery expense, we're talking freight out, actually, freight out. And the selling department might consist of offices all around the country if it was a bigger company. So you would have the rent on that building, maybe the mortgage payment, that type of thing would be part of the operating expense. Okay, so it's not just the salaries of the salesman and commissions.
Why wouldn't, okay, yeah, I get it.
Question?
No, I'm just wondering why sales commissions wouldn't go into cost of goods sold. Well, no, I guess it's not a cost of the goods.
No, we've already bought it by the time our guys sell it.
Yeah, okay.
Yeah. General and I call these general and administrative, okay? General expenses. This is just about any other expense you can think about. We're talking about the offices, the president of the company, the accounting department, the purchasing department. You know, we might have a maintenance department if it's a factory. If it's a store, we might have security guards around the place. All of that is operating expenses that are in the category general and administrative, okay? So it's really not too much different than what we were doing earlier. So let's take a look at this. Here is our spreadsheet. Okay, so this looks like this is the partial spreadsheet, and it's strictly the bottom part. Remember, I always told you draw a line above the first sales line. So everything below that is your income statement. So look at how this has changed here. Sales minus sales returns to net sales. That's not new. Okay, so we have net sales, and now we're going to subtract what? The cost of goods sold. We're going to subtract the cost of goods sold. We're going to compute it the same way. We're going to take the beginning inventory plus the purchases less the ending inventory, to get cost of goods sold. At that point, there's nothing different from what you've learned now. Here is the only difference. We are now going to take the cost of goods sold out of this pile of expenses and move it right up here. And we're going to take the net sales. Let me get this out of my way. We're going to take the net sales, which were 465. We're going to subtract the cost of goods sold. Looks like that's 220,600. I'm sorry, 244,300. And now we have something called gross profit. Gross profit, 220,600. So this company now has something that might prove more useful than mixing in all the expenses. At this point, this company can say, let's see, we had 465 in sales, 244 in cost of goods sold. So our cost of goods sold is more than half of our total expenses. And that's something you'd probably really want to know. You want to know. You can control the gross profit by buying cheaper products or selling more. You can attack that. Hi, Jamie. You're muted.
How are you?
Good. Welcome. Say hi to
Thank you.
Roby and Natalie. We got our group here.
Jamie.
Hi,
Jamie,
Roby. Hi, Natalie. Sorry, I'm staying muted just because my toddler is watching The Little Mermaid.
Okay, real quick question. Are you taking 240 now too?
2:30.
230. So you're taking 110 and 230?
Yeah.
Good. Because okay. I saw you in the 230 class. Okay. Okay,
It's
go
very
mute.
fun.
We'll talk about it later. Okay.
Okay.
Okay, mute away. Okay. Okay, Jamie, I know you can hear me, Jamie. When you came in here, we were talking about a new presentation of the balance sheet. And if you're taking 230, I'm pretty sure you know this already, okay? We're talking about coming up with the cost of goods sold. In 110, you guys haven't seen that, right? So what we're saying here is we got our gross sales and we get our net sales. And we're going to do exactly the same thing we've been doing in 110. We're going to take the beginning inventory and we're going to add the purchases and we're going to subtract the ending inventory to get the cost of goods sold. Beginning inventory plus your net purchases gives you what's available. That's the most you could have possibly sold, right? And we take a physical inventory, subtract it out. There's our cost of goods sold. So that's the same that you've been doing at 230 and what we've been doing in this class as well. The only difference now is when we come up with the cost of goods sold, we're not going to put the cost of goods sold expense down with everything else. We're going to separate it because we want to see something called gross profit, gross margin. And I was just saying before Jamie joined us, in this case here, management has some information that would otherwise be hidden if you put all this stuff together. Okay, let's look at cost of goods sold. What are we paying for our products? Well, we sold $465,000 worth of dresses and we paid $244,000 for them. So I was just saying, this company cost of goods sold is more than half of its expenses. So that's a big chunk and something they might want to attack in different ways. Gross profit, all it is net sales minus cost of goods sold, okay? Gross profit. So, and this is a pretty nice presentation, by the way they got this thing set up, huh? So here we go. Now we're going to subtract our operating expenses. And we just learned that we have selling expenses and what this book calls general expenses, general and administrative. So here's what we do. Here, they're not breaking them out. They're not breaking them out. They are listing all of the expenses here as operating expenses. So wages, we can't tell what that is. That could be selling or admin. Advertising is selling. Bank credit card expense, we called it, they said it was selling earlier because only a salesman get a credit card. But our total operating expenses give us our net income from operation. And this is, you've heard this, maybe you guys heard this before. The mnemonic that I like on this is some clowns get silly at night. Have I used that expression before? Some clowns get silly at night. It's a way to remember this. Some sales, clown, cost of goods sold, get gross profit, silly at night, selling, admin, net income. You may like that kind of stuff. Others, it doesn't really help them. When I took the CPA exam so long ago, they filled us with these kinds of mnemonics. And to this day, I can remember the what do you call them, mnemonics, without quite remembering what they stood for. But at the time, they were so important to me. Okay, so this is our new look. Same thing we did before, except now we're coming up with this thing called gross profit. Wow, how did we jump to a statement of equity from there, huh? It doesn't, seems incongruous. Okay, the statement of equity. We've been over this many times. Beginning equity, right? Plus income, less. In this class, we have drawings, less drawings to get the ending. Sources we need the worksheet. My goodness, we've been over this enough, huh, guys? Statement of equity. You take the beginning and you add the net income and you subtract any drawings, okay? So on this one, my mnemonic is bide. Do you ever bide your time, Roby?
Oh, yeah.
You bide your time, right?
Yep.
You got to bide your time. You start with a beginning, I for investment and income, less drawing equals ending. Mnemonics, huh? Mnemonics. That's how you learn the Great Lakes, right, Roby?
Well, I have not used mnemonics that often, but I don't know. I just remember them one way or the other.
Well, I can't remember them without Holmes. You got to go Holmes. You're on Ontario Superior area. What the hell the last one is, Superior. Okay. Classified balance sheet. Again, I don't think this is anything new. All you're doing with the classified balance sheet is breaking out current assets in one clear number off to the right. And this is a good presentation, but it's not the only one, you know. And you do the same with the liabilities, current liabilities. So we have assets equal total liabilities plus equity. Any questions on that, Natalie? So far, so good, huh? We're going to have the babies appear in a little while, okay? We'll take a break. We got 2 babies. 3 if you count this guy. Current assets, my goodness, we know what a current asset is. Something we're going to chew up in a year, right? An asset, we're going to get that benefit in a year. Inventory, when you buy inventory, you certainly hope to sell it within a year. Cash, nothing more liquid than cash. Anything that we can turn into cash, liquidity, 1 year. Property, plant, equipment, not so liquid. These are called fixed assets, long-term assets, fixed assets. It can be land, building, equipment, cars, forklifts, all kinds of things. Assets with longer lives are listed first. I didn't know that. Assets with longer useful lives are listed first. I really never knew that. I'm not sure that's even right. I mean, normally you just go machinery. Well, I guess you do within each category. Current liabilities. We know what these are. Bills are going to be paid within a year. Accounts payable. That's what you owe to your suppliers, your normal providers of services, like the electric company, the people you buy your garments from, where you buy your supplies. Notes payable is a borrowing arrangement that includes an interest part that you have to pay. And in the event your company goes south, people who hold the note will get paid in a bankruptcy before accounts payable. And we didn't do this too much where I work, but we did do it once in a while. We'd have a customer who would be late paying us, and we'd be chasing him down for 60 days. And he would say to us, look, if you trust me, give me a year more and put it in and I'll sign a note for you, and I'll pay you monthly interest until I pay you back. Well, that usually worked because the people were honest. But if the guy did go bankrupt, by having it in the form of a notes payable instead of accounts payable, we had a little better chance of getting paid. Long-term liabilities, mortgages, huh? Mortgages. 30-year notes, owner's equity, different kinds. I really feel like we're going back to the first chapter again, huh? Sole proprietorship, personal risk. You can set it up pretty easy, but you know that little flower stand that you started, Natalie? You put like $1,000 to start that business. That business has gone so bad, that business now owes $1 million. That means you personally are responsible for that million. Same thing with a partnership. Same thing with a partnership. Partnerships you typically see with intellectual services like architecture, legal, law firms, CPA firms. And I really think the reason they like to call themselves a partnership is they're demonstrating to the world that they're not afraid of getting sued personally, that they're confident that they provide a good, honest service. But you can limit your liability with a corporate in a partnership in other ways, and that's way over our heads, at my head too at this point, with a limited liability corp or an S corp or something. Standard financial ratios. Standard financial ratios. Did you do your first FSA, Jamie? Or you're in Laura's class, right?
No, Professor Terry.
Oh, she doesn't give out the FSA. Okay, never mind then. It got moot, my point. Financial analyses used by management and creditors. There's a million of them, huh? Let's look at three. Working capital, current ratio, quick ratio. Working capital, current assets minus current liabilities. Okay. So this company, Sunflower Cycle, has assets, current assets, 127.9, and they owe 34.8. Current. The difference between the two is working capital. Another way to talk about working capital is it's the amount of money you have left over if you chose to pay all of your current liabilities, okay? Working capital. Companies look at that all the time, especially companies that might be a little bit short of cash. They're checking that all the time. Working capital. If this number was less than, less than zero, was negative, technically they're insolvent. They're insolvent. So at that point, they're going to have to sell something quick and get a little infusion of cash. You go out of business without working capital. So we're going to measure the working capital. Okay. I am hoping somebody invests in the Bob Smagula company. Okay. I'm working with a pharmaceutical company to cure baldness. Okay. We're going to come up with that before the next couple of months, we hope. Okay. And people might want to buy into my company. So they're saying 2-to-1 is probably a good ratio. I'm not going to say what's a good or bad ratio, other than statistically, the higher, the better. But so what are we doing here? We're taking the current assets, dividing them by the current liabilities. So that's 2.5-to-1. 2.5-to-1. What that means is this company would have $1.50 left for every dollar that they pay off. Okay. They will have $1.50 left for every dollar that they pay off in current liabilities. Okay. So and of course, when you divide 87 by 35, it's a percentage, but we're not going to call it that. We're going to call it this ratio, 2.5-to-1. 3.5-to-1 would be better, right? That's a lot of liquidity. 10-to-1 would be good. You know where I'm going with this question, Robbie? What if it was like 40-to-1?
40-to-1. Wow, you got a lot of current assets relative to the current liability.
Yeah. If it was 40-to-1, you'd have a ton of cash, right? A ton of cash, probably. Is that good or bad, you think?
Well, I don't think it's that great, because that cash could be invested in something.
Exactly right. Exactly right. If you have a current ratio that's ridiculously high, let's say more than 10, just to pick a number, you might have some better use for that cash, especially now with interest rates at historic lows. Next year, it's hard to believe it was that long ago. I was living in North Carolina at the time, and I bought 30-year treasury bills. I had some extra money lying around and I was a little worried about my future. Anyway, I bought these 30-year treasury bills. They pay 9%. So that's a pretty good return, right? They
How long ago was this?
This was 1993.
Oh, okay.
So it's 03. So let's see, 03. So what's that? 03, 13. So that was 27 years ago. I bought them when they're about 4 years old. Okay. My point is this. If you bought that same 30-year treasury today, I believe I heard the shocking news. It's below 1% now. Can you imagine people tying their money up like that for just a tiny percent? So the point is, if you're holding money right now, that's a problem. And corporations are still doing that. They are still very worried about what's going to happen to the economy with the presidential change, the strife in other countries. The Brexit issue in England has still not been resolved. Worried about war in Northern Ireland again. So companies are hoarding cash. When they let that cash go back into the economy, big help. That's why in the meantime, I'm getting on a little bit of a soapbox. That's why in the meantime, I strongly feel we need another big stimulus package from the government because that money will be spent immediately. Okay, we just talked about the current ratio. Let's talk about another one called the quick ratio. Quick. Here, we're going to ignore the inventory and the prepaids, basically. We're going to look at just the cash, accounts receivable, and any temporary investments. What that means, everybody, is we bought stock in another company. Our company had so much money left over. We bought 1,000 shares of IBM. We bought 1,000 shares of Apple. We bought 1,000 shares of General Motors. Those are included in the quick assets. These are the assets that are most liquid. So we're going to ignore the inventory and the prepaid. So take a look at your quick assets. Quick assets. Cash and accounts receivable mainly, huh? Cash and accounts receivable divided by the current liabilities. Here, they're talking about a 0.6 to 1 ratio. Again, I don't know if that's a good number or not. But here, if this is pretty even, you're probably in pretty decent shape, okay? Because you have inventory that you still need to sell. Hey, Jamie, is that your daughter? Obviously. Hey, what's her name?
Sage.
Okay, we'll get Natalie's daughter up here in a second. We're taking a 30-second break, class. What's your name again?
Sage.
Sage?
Uh-huh.
Oh, Sage, how you doing? Hey, how old is Sage, real quick?
3.
3? All right, you ready for something, Sage? Watch this. You're gonna love this. Ready? Da 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 da. Da 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 da. Da 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 da. No, Sage is saying this guy's an idiot. This guy's a teacher. Okay, we shall continue. And you'll get to meet another guy in a minute here, another young lady. Here we go. Okay, quick ratio. Here's one we got to think about a little bit, huh? Return on owner's equity, huh? Well, the company has a certain value on paper. We're going to take our income and divide that by the average equity. And the average equity is simply whatever the total stockholders' equity was at the beginning of the year, added to the average, to the number at the end of the year and dividing by 2. That's all it is. So what do we have here? We have a company that had $100,400 in income. The equity, I'm assuming it went up. It went from 407 to 413. When you average them out, you get 460,400. 100 divided by the 460. This is called return on equity. Return on equity. This means that for every dollar that our company is worth, we generated 22 cents, almost 22 cents. So I think a 22% return is pretty darn good in these in these days of lower interest rates, huh? So this guy, whoever started this business, he was wise to start this business because he seems to be earning 20% of what the company is worth right now. Okay. Any questions on that one, Natalie? It's net income divided by the beginning and ending equity divided by 2. That's all it is. Now here's one. Now Jamie just left us for a second, but here's one that Jamie would have had to do on what's called the FSA. My 230 class has to do this by next week. You're beating the 230 class. How about that, huh? Okay. Accounts receivable turnover. What an important statistic. It measures the time required to collect cash from credit customers, not cash customers. There is no credit problem with cash customers. So if you ever get a problem to do with this and they indicate that some of the sales were cash, you have to subtract the sales out. We only want credit sales. So indicates the turnover, indicates the number of times accounts receivable turned over or were collected, huh? That's kind of difficult jargon, I think. The turnover represents the number of times you collected the average cash that was due to you, the average accounts receivable, okay? But if you go into a business with your boss and the boss's background is not the numbers, the boss's background could be engineering or production or, sales. And he'll say to you, well, how do we do with our cash collections? And you say, hey, boss, terrific. We had a 9.6 turnover this year. And the boss is probably going to say to you, so what? What does that mean? And you don't want to get into a conversation where you're going to say, oh, well, it's the number of times we sold the average inventory. What we're going to do is this. I hope I see it. Oh, thank God. Here's the way we're going to talk about it. There are 365 days in a year. You divide that by the turnover, and that's 38 days. This company collects cash from its customers on average in 38 days. It's as simple as that. What do you think, Roby?
That's pretty good.
Yeah, 38 days would be wonderful. I've never seen a place that was below 45, to be honest with you. Here's I'm just going on slightly more off a tangent again, but it has to do with the subject. If a company is issuing credit and all their customers are paying within 20 days, that's great. But it also indicates a possible problem. You have any idea where I'm going with this, Roby? If everybody is paying you that quickly, it might be not so much that they're good payers, but that you're unwilling to sell to people who could be a problem. In other words, anybody can sell something to, Coca-Cola, and you're going to get paid. The trick is to sell to as many people as you can, assessing the risk of each one. So 38.2 is good. Inventory turnover. If accounts receivable turnover is the the sales divided by average accounts receivable, the inventory is going to be the total cost of goods sold divided by the average inventory. Inventory turnover. Here again, the number of times we sold the average inventory balance, okay? And again, you go to your boss, say to him or her, we got a 4.8 turnover. Don't do that. Here's the calculation. The beginning inventory plus the ending inventory divided by 2. I guess that equals 50,450. Our cost of goods sold was 244. Do you remember that when we looked at the income statement? I think they're using the same number. So we turned over the inventory 4.8 times. 4.8 times. If we divide that into a year, we get 76 days. This company needs 76 days on average from the time the merchandise arrives until it goes out the door in the form of a sale. Okay. So they're collecting money really quickly, but they have a lead time, I guess we could call this, of about 76 days. Okay. 76 days. You want the days to be as low as possible, right? And the turnover is as high as possible. One drives the other.
They should probably cut back on their buying, huh?
Well, yeah, I mean, it would depend on the business. Again, it could be they're selling to, it could be they're doing some custom type work that takes extra time. It could be an industry standard. I don't know. But 76 days seems like a long time before you sell your merchandise, wouldn't you think? But that's where this company is. They're great at collecting money, but when they do, but when they have to sell it, it takes a long time. Okay.
I mean, you've got a lot of stuff just sitting on the shelf.
Of course, it's sitting there for 76 days. Yeah. 76 days. Closing entries. Well, we've been over closing entries, but we're going to come up with a new one here. I think we already did this too. Closing entries for merchandise. It's pretty much the same except the handling of the inventory, okay? Closing process. We're going to close all income statement accounts are debited, and then all expenses get credited out, and that's going to represent our net income. We've talked about the income summary in this class. Am I correct? Or is it the first time you're seeing this? Okay, I must be mixing you up with my 230 class. So, hey, Sage, how you doing? Here we go. All right, closing entries. We're seeing this for the first time. At the end of each month, we have to take the net income and move it to capital. And we know we do that because we prepare that one report called stockholders' equity, where we buy at our time. The beginning equity plus net income minus drawings equals the new, okay? I even have a prop for your daughter, but she might be too young. That's from a meeting with my grandnephew back in New Jersey. He's an idiot. Okay, I get back to this. We have to close sales and expenses. So here we go. Look at all your sales accounts here. We have sales and we have interest revenue and all these things here. Anything that is on your income statement that has a credit balance. So here they're showing you the revenues. We have to close those. So what we've done here is we've debited all of these accounts that have a normal credit balance, right? And we're adding them up. And we're calling the total of those. This is our total sales. The 450. Well, let's pretend it's total sales. I'm not going to worry about the purchase discounts and stuff. Total sales, 485, credited to income summary. Income summary is an account that will always have a zero balance at the end of the month. You're going to see it's just a closing, just a clearing account. So step one, debit all the sales. Step two, credit all the expenses. Credit all the expenses. So the difference between this credit and this debit is your net income. Would you agree, Roby?
Yep.
See what we're saying, Natalie? These are your sales. These are your expenses. So we put the sales into income summary, and we put the expenses into income summary. So over here, remember, and so they're doing it in one journal entry here. So they took the 453, 485, whatever that is, subtracted it out, and they end up clearing out the income summary, which now has a credit balance, and now we credit capital. Credit capital. Closing entries are a little tricky when you first see them. You've not seen it before. But as long as you remember 4 steps, I think they teach this much better in 230. You agree, Jamie? At 2:30, they give you a much better look at it than this, I think.
Yeah, there are a lot of good graphics that make it.
Yeah. This is lacking here. Okay, but we'll work with it now, and I can always call that up if you like. There's 4 steps. 1, zero out the sales accounts with the debit. Step 2, zero out all of the expenses with a credit. Step 3, zero out the income summary, which now has the net income in it. Clear that out to capital. Oh, here's Millie. How you doing, Millie? Clear it out to capital. Clear it out to capital. Step 4, close drawing directly to capital. Drawing directly to capital, huh? Is Millie ready for our weekly act here, real quick? Millie's seen this a few times. Hi, Millie. Ready? Here we go. Da 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 da. Da 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 da. Da 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 da. Come on, I'm working hard for you guys. Oh, Millie's a veteran. Sage is going, this guy, Jesus. Okay. Closing. Yeah, try to practice these, okay? The 4 steps. Close income, close expenses, close income summary, close drawing. Huh? Is there a mnemonic for that? I can think of one, I guess. Close sales, close expenses. Okay. Once you've done that, you have now removed all of this from your trial balance. This is all gone. You no longer have this on your trial balance. By definition, you zeroed it out. So now we have to prepare what's called a post-closing trial balance, which again serves only one purpose, to show that debits equal credits. But look at what this looks like. You notice it ends at capital, right? Hey, Millie, why does it end with capital? It ends with capital because we got rid of all the income statements. Thinking about this, Roby?
Yeah. No sales, no expenses.
Not on the post-closing trial balance. This is just a snapshot in time. You could probably think of this as just 1 second, or maybe an 8-hour period or something. The month has ended, right? And then you have maybe 3 or 4 days to do your adjusting journal entries and the closing entries, which of course you're backdating to December, say. The minute you have zeroed out all those expenses into capital, your new general ledger will reflect an opening balance without any expenses or revenues in them automatically. Okay. Closing entries tend to scare students, I think. They get a little nervous with them. I know my 230 guys are still fighting it a little bit, the new late start class. What do you think, Jamie? Did I explain that pretty clearly?
Yeah, I think it makes sense.
Why don't you tell them about it?
Well, the way that I look at it is when you clear out, this is permanent versus temporary accounts, right?
There you go. Yep. Yeah, they don't even mention that. Go ahead.
Oh, okay, sorry. The permanent accounts are on the balance sheet, so they maintain a balance, whereas the temporary accounts are all in the income statement. So at the end of each period, when you credit the expenses and debit the income, it zeroes out all of the accounts on the income statement, and those are considered temporary accounts.
Yeah. And now that income is in your income summary. Yeah, they don't talk about temporary and permanent, but yeah, your income statement are called temporary accounts because they only have the life of a month. Okay. They're like a fly. They only live for about a month. Okay. The balance sheet goes on forever and ever. You never close out cash or anything like that. Okay. Temporary and otherwise. Do we want to get into reversing entries? You've not been taught reversing